So have market fundamentals really changed? Is Brexit just an illusion? It sounds like a song, but we did see the global markets treat the Brexit vote very, very seriously on the Friday and the Monday. And then it became a political, not an economic event. And suddenly markets recovered. We saw the FTSE 100 by Wednesday bouncing back to pre-Brexit levels. The FTSE 250 more tied to the United Kingdom economy. That was down about 8%. But we've seen an extraordinary revaluation of the rand, which is even recovering some of its losses against the euro and the dollar. And also better for the first time in a year almost than 20 to the pound. We're seeing huge investor appetite for emerging market bonds. And we are seeing this desire for high-yielding, riskier assets. Our own economy is a beneficiary of the big Brexit burnout. This is the MoneyMakers. I'm Bruce Whitfield, and I'm joined by Mohammed Nalla, Head of Strategic Research at Nedbank Corporate and Investment Bank. Let's talk about the big changes that have happened as a result of 17 million people in Britain giving us an economic leg up. I mean, am I being completely mad in my perspective that actually Brexit is brilliant? Thank you, Boris Johnson.
Well, it certainly appears that way. And I mean, everyone in the market's really gone wrong-footed on this. And now that you've got this 180-degree turn, you're seeing risk assets rallying across the board. As you mentioned, you know, you've got a stronger rand, you've got stronger South African govie bonds. It's quite inconceivable, but the real reason for it is almost unrelated to the Brexit. It's that the Brexit introduces growth risks to the world economy. In the context where Janet Yellen's been saying, we think it's getting better, but we're worried about growth risks, global risks, they gave her a global risk. And so because it's effectively taken the prospect of a Fed hike off the table for this year. In fact, Fed funds futures are now pricing in the probability of a cut from the US Federal Reserve by the start of next year. Yes, it's gone from pricing in roughly about a 40% probability of a hike by the September meeting just prior to Brexit to now pricing in a 20% probability of a cut from the Fed by January next year. And that's really what's driving markets.
Now, I saw some numbers out of Credit Suisse this week, and the Credit Suisse numbers, they went from a 2.3% growth rate for Britain forecast for 2017 to contraction in the UK economy of 1%. That's a big turnaround. That's a 3 percentage point turnaround in their expectations as a result of Brexit. Now, that's if Brexit happens, of course, because we see the politicians fall over each other to exit politics. Never mind get out of the European Union. Even Boris Johnson doesn't want the job of Prime Minister anymore. He's the dog, and I've used this on the show before, but he's the dog that caught the bus and didn't know what to do with the bus. So he's given the hospital pass to others to deal with the mess that he helped create.
Yeah, they were happy to break it. No one wants to fix it. I mean, I think right now it's quite smart because Cameron came out and said, I'm not invoking Article 50. You guys, you voted for someone. Let someone who backed this actually invoke Article 50. And so right now, that's the reason why, you know, there's a question mark. Will there even be a Brexit? With or without a Brexit, this is going to be negative for UK growth because remember, the uncertainty is what's constraining investment in business. It's what's going to constrain their property market. And all of that drag on the UK economy. I mean, they weren't in robust health just prior to the Brexit in any event. If you look at their manufacturing sector, it's been in the doldrums and in contraction over the last several prints. So all of that's just going to come through with a drag. Whether it's a 3 percentage point swing or not still needs to be seen. It depends on, you know, how do those trade negotiations play out, when or if they actually invoke Article 50 or not. Interestingly enough, European markets haven't recovered as strongly as the UK markets have recovered.
Because suddenly we've got an uncertainty about the stability of the European bloc. I mean, that's what Brexit has shown is the vulnerability of the EU as an economic construct. It's a great political construct, no doubt about it. Stops people killing each other. And Europe has got a bloody 4,000-year history. I mean, people have been clubbing each other over their heads since before people wrote that down. It's, you know, it's been a very good political solution. Economically, suddenly it's under threat.
Yeah, and it's interesting because there's some people out there that actually say, you know what, they're gonna have to make concessions for the UK because it's such a large market for them as well. And I differ with that because I think game theory for me dictates a different outcome. And you're starting to see it. Merkel's actually come out towing a much stronger line. She's actually saying, well, but she has to because that's what's going to drive European unity. They're going to have to make it so punitive. They're going to have to illustrate that leaving this family, as they call it, the European family, is definitely not in your best interest. And so all of you guys asking for referendums in your respective countries, no.
This is back down again. There is no, I mean, at the Old Testament story of the prodigal son, there is no prodigal son opportunity for Britain. Once you're out, you're out. There is no, you don't get brought back in again.
And that's what Juncker's been indicating. It's what Merkel's been indicating as well. And if they don't drive that point home, I then would say yes, the European experiment is looking a lot more fragile. The fact of the matter is Europe doesn't work just as a monetary union and not as a fiscal and a more federal union. And right now, it's an incredibly tough sell. I mean, you've got it's 5 point or some 5-star in Italy that's gaining traction. I don't think this European risk goes away for the foreseeable future.
Now, ideally, we want a stable world with whom to trade and with whom to be best buddies and who to visit, and they can come visit us and spend their money here and we spend our money there. Kumbaya, it would be really nice to have a nice stable world. The world is not a stable place. It is deeply uncertain. Goodness knows which way the Americans are going to go in their November presidential elections. But that instability is playing out positively, at least in the short term, for South Africa's macroeconomics.
To a degree, it's more positive for South African markets than it is the macro fundamental picture, which hasn't really changed. I'll tell you what has changed is over the last month, prior to Brexit, you've had an 80 billion rand inflow into South African assets, 50 billion into equities, 30 billion into bonds. For the year as a whole, bonds have been doing the heavy lifting. But that's a complete about turn on foreigners that were remarkably bearish on South Africa over the last
They've not turned positive on South Africa, they've just turned bearish on Europe.
Absolutely. It's actually just a global search for yield. That's what you've got. The fact that the Fed hike is off the table means that the global carry trade's back on. If you assume that the Bank of Japan is going to give you more stimulus and possibly the ECB as well, it means that in a construct where global yields in Japan and Europe are in negative territory, you can buy a German Bund 10-year, it's negative. You can buy JGBs, they're negative. So in that construct, South African All Bond has given you an 11.5% total return this year if you don't count the currency move that's actually been positive for you on a year-to-date basis.
However, the currency now has rallied a bit against the dollar and the euro. We're better than 20 to the pound for the first time since August last year, my best calculations. That is an extraordinary turnaround because you've been Captain Papa Bear on the rand for a while, on the fundamentals of the South African economy, on the prospects of a ratings downgrade. Is it causing you to change your mind, or are you still watching and waiting to see how this saga plays out?
So I'll map it out for you. The biggest change for me has been our view on the rand. We've got to be less bearish on the rand because the fundamental premise...
Bearish, does that mean you're more positive, or does that mean you're just less negative?
I'm less negative.
So you don't see the rand going to 12 or 13 to the dollar?
I'm not in that camp. I'm not in that camp. Yeah, I'll tell you how we've revised it. Is historically, we were in the camp of seeing 1630 to 1650 by year end, but that was largely on the back of the fact that we expected the Fed to hike in September. Now that that's off the table, you could easily see the rand with a 15 handle by the end of this year. I'm not in the camp of the 12. I'll gladly take it. If we get 12, absolutely. But I'm in the camp of seeing us pretty much range bound over the course of the rest of this year. The macro fundamentals haven't necessarily changed materially. Where we have had an uplift from the weaker rand has been the trade numbers have started to actually come through slightly more positive. But the fact of the matter is, if the rand now strengthens, some of that positivity actually leaks out of the system. Unfortunately, is a ratings downgrade off the cards just yet? I'm not convinced.
No, but...
we bought time,
Bruce. We bought some time.
And that's fantastic.
In the scenario where the Fed doesn't raise rates until next year, possibly even cuts next year, maybe it puts rates on hold until 2018, for goodness sake, which is one of the stories that has been bounding about today. In that environment, the pressure on the Reserve Bank, especially with a bit of rand strength, to raise interest rates dissipates. We end at the end, but then potentially, of the rate hiking cycle in South Africa, and potentially our Reserve Bank has to cut by as early as next year, and that could provide some stimulus. Now, these are scenarios, possibilities that can be gazumped by elections, by ratings agencies, by the national sport of shooting ourselves in the foot.
And those factors are why I say I'm less negative, but I'm not positive just yet. Is unfortunately that backdrop for me is still not fantastic. What's going to make you positive? What will make me positive is we start putting the right policies in place, if we start actually changing the political and social narrative in South Africa. Because right now, it reminds you of the taper tantrum. We had all of that negativity, and then the Fed said, well, now we're not going to actually hike rates anytime soon. And that bought emerging markets and South Africa time. This is it's a replay of that. We're buying time. Let's not squander that time. If we use this time appropriately, and I agree, I think the SARB is probably been given a respite, not just for this year, but this might be the top of the cycle, or worst case, you get another 25 basis points. That means that the distress that you'd be factoring through to the consumer in South Africa gets eased significantly. It means that instead of having a much deeper correction, you might just have a low growth, But that's why I say to turn positive, you actually see the right policies being promulgated. That changes the narrative for South Africa.
Is the threat of recession, because a lot of people are talking about South Africa going into recession this year, is that pushed back?
It might soften a little bit. I mean, we're still quite bearish on the growth outlook domestically. We still have a 0.2 number as our full year number. Some people are actually saying it still could go negative, but in this kind of context, we'll take any positivity when we can get it. What happens with a stronger rand is inflationary pressures abate, and that eases some of the pressure on the Reserve Bank, which means that they don't necessarily have to exacerbate the downturn in the economy.
But without any action from the work streams and from the good work that has been done in the first half of this year with the Treasury and Business and Labour, without something coming to bear from all of that talking, and I've spoken to a bunch of people who are in these organizations, in the work streams, they're having late night meetings, everyone's talking, and they want to do the PR and they want to start talking South Africa up to try and get a little bit of stimulus going, but without action, we're not going to get the growth, we're not going to get the change, and the change that you want, which is labour policy, simplification of business registration and processing, all of that important stuff that really does need to change, which probably won't, we're not going to get the growth we need.
Yeah, that doesn't change overnight, but we need to show some sort of sustained shift in thinking. And I'm not convinced we're there yet, unfortunately. It's why we're still a subpar growth in the emerging market world. I mean, assuming this gives you the window of opportunity to steady the ship, to get things right.
Either it gives us the window of opportunity or it gives us an excuse to delay further.
And I fear that if it breeds any further complacency, unfortunately, we just end up with the same mess we've got right now further down the line, 18 months. You know, if the Fed cuts, if they actually cut rates next year, that might buy you a much bigger window of opportunity, but unfortunately that might also buy you a bigger window for complacency.
Yeah, and that's the risk we face right now.
And that's the reason why less negative, but not yet positive.
There we go. At that point, we will leave it. Mohammed Nalla, thank you. He's Head of Strategic Research at Nedbank Corporate and Investment Bank. Certainly things are very politically charged right now. Economic opportunities, though, do abound. I was chatting to Christo Visa, the great South African retail entrepreneur, and he loves a good crisis, even though, according to Bloomberg, the Brexit crisis on Friday cost him about $600 million. He won't blink. He won't flinch. He'll look for opportunities as the Brexit crisis causes havoc in a country where he's been investing a lot of his own money. Maybe get him on the show one of these days. Producers, you have been tasked. From us here for the show for this evening, thank you so much for watching.